thanks to the organizers for hosting this conference, sort of an important event to and an opportunity to experience views and thoughts on a topic that is high on the agenda in many countries, including my own, as I will show you. House price inflation is a leading indicator of financial crisis in Norway and elsewhere. See take the long view for a moment. The intensive housing market speculation in Norway's capital at the end of the 1800s resulted in a financial crisis, what's called the Christiania crack. Oslo was called Christiania previously. 80 years would pass before real house prices in Norway had returned to their pre-crisis levels. During the build-up to the Norwegian banking crisis of the 1980s, in Oslo, real prices would take 100 years until the beginning of the 2000s to return to this level. House prices in Norway have risen considerably over the past 20 years. House prices fell only slightly during the financial crisis of 2008-09, which did not hit the Norwegian economy as severely as many other countries. But in the last years or so, there has been a new acceleration of house price growth in large part of the country with double-digit growth, including Oslo with much higher price growth. However, what should concern us most is not house price inflation, but credit growth. A number of analyses for Norway and internationally has shown that a recession is deeper and lasts longer if pre-recession credit growth is high. Strong house price inflation alone does not lead to a deeper recession. However, house price inflation rarely occurs alone, as a rule. As a rule, house prices and credit growth tend to move in tandem, as also the previous speaker pointed out. Credit available depends on debitors' net worth, their collateral. So real shocks are amplified by the financial sector, by this financial accelerator mechanism. Increased house prices, increased credit needed to buy a house. This increases demand for credit. House purchases are secured by properties itself. This tends to an increase in prices increase the net worth and the borrowing capacity, and bank assets appear less risky, and this may stimulate lending. So this pro-cyclical feedback mechanism may be a central mechanism behind the pattern shown in the figure, and is sort of the main reason why credit growth and property prices are assessed together from a financial stability perspective. In Norway, total credit has grown faster than GDP for a long period. And this is primarily driven by household debt growth, in particular since the financial crisis. Corporate credit has grown in pace with GDP since the financial crisis. This is why the credit gap in total has narrowed. And so you see the importance of house prices for debt growth can be illustrated here by Norwegian microdata. The analysis is done by Kjersti Næss Torstensen, who is also in the audience, where we combine microdata for housing transactions with tax assessment data. These charts then show the net change in household debt, and we decompose it into individuals that are involved in property transactions and those not involved, so in a given year. So the blue bars are the individuals or households involved in property taxations, which amounts to between 8 or 10% of the individuals in a given year, and the orange bars are the other households. So for the most part, household debt growth in Norway is driven by home buyers. So although borrowing was high among other households also before the financial crisis, home buyers have been by far the largest contributors to household debt. So what you see here, the figures are the net figures for both groups. So in each group there is also actually down payment. So what we see that in the group of other households not involved in transactions, there are considerable amount of individuals or households that actually pay down their debt. But as we see in each years, the net increase in debt total for this group is positive. So the dynamic of the figure, typically if I buy a house and take up debt 1 year, I wouldn't be in the contribute to the blue bars, and next year if I amortize on my loan and don't take up new debt, I will contribute negatively to the orange bars. But you see that in none of these years, apart from 1994, where it's the first year where it's actually zero or slightly negative, also the non-buyers of houses increase their debt, although the house buyers are the ones that contribute to household growth. So then going on, as we see here, here we see look at the debt increase for home buyers and the debt increase for stayers, or not those that are not involved in housing transactions but nevertheless increase their debt. What we see from the left-hand side chart is that borrowing by home buyers is determined by house prices. See, the left chart shows that average borrowing by home buyers has increased, measured in nominal terms and relative to income growth, but compared with house price inflation, the borrowing has remained fairly constant. It gives us an approximately constant loan-to-value ratio. The chart on the right-hand side shows average borrowing for non-home buyers that nonetheless increase their debt. The increase in debt for this group has tracked income growth fairly closely, and it's lower than house price inflation. Indicates a low degree of home equity withdrawal, except for the years before the financial crisis. We're looking at the total figures. Total household debt in Norway relative to disposable income has been increasing for a long period and is quite high, 225% of disposable income. Nonetheless, the interest rate burden is low because of low interest rates. If we include estimated mortgage repayments and look at the compute the debt service to income ratio, household spending to service debt is about the same now as it was before the Norwegian banking crisis at the end of the 1980s. But this high household debt makes Norwegian households vulnerable to interest rate increase and reductions in income. Also, the share of vulnerable households is increasing. Here we look at households with debt for more than 5 times disposable income and decompose it by the age of the main income earner. You see that this share has increased in all age groups, also among the older age groups. It averaged about 15% for the whole population, and it's around 25% for the youngest age group. If we look at this from another in terms of gross income, which I'll come to later, because gross income we'll look into later in the macroprudential measures introduced. It has also increased. Of course, the figures are lower because we use gross income, but the pattern is nevertheless the same. So even though our main focus in assessing financial imbalances is on household debt, weight is also given to development in property prices. House prices have risen considerably more than household disposable income over the past year. Household as a share of per capita disposable income are significantly higher now than before the financial crisis. Total disposable income has grown more than per capita income as a result of high population growth over the past 10 years. That was also why we include this per capita measure in the left-hand chart. And over the last year, house prices have surged. The year-on-year rise was 11% in April for the country as a whole, and it was even higher around New Year. But house prices are not uniform at all across Norway. Prices vary considerably across cities. And in the past year, house price inflation has been particularly high in Oslo and the Oslo area, with over 20% rise over the past 12 months, while prices in the oil city of Stavanger, as you see the bottom curve in the right-hand chart, there has been the house price growth has been negative following the negative oil price shock in the summer of 2014. One must remark that the house price growth in Stavanger had been considerable in the years before that. So, as we view it in Norway, there are two significant vulnerabilities in the Norwegian financial system: high household debt and persistently high property price inflation. And this makes the economy vulnerable to shocks, to income, to house prices, and interest rate shocks. A rise in unemployment or fall in house prices could result in both a fall in consumption and an increase in mortgage defaults. The probability of a sharp rise in residential mortgage default, we view that as moderate, nevertheless. A fall in household demand following such a negative shock could affect corporate earnings and debt-serving capacity, and banks' losses on corporate loans could rise. And these losses could impair banks' credit capacity and contribute to amplifying the downturn. So, house prices are linking here is house prices are typically leading credit growth. The main macroprudential measures to build resilience and capital requirements for banks and mortgage are capital requirements for banks and mortgage requirements for households. More capital increase bank resilience to future loan losses and may also contribute to curbing house price inflation and credit growth if banks increase margins in order to build capital. Requirements imposed on banks' credit standards have a more direct effect on household borrowing, limiting the share of borrowing that stretches the boundaries. And limiting the share of borrowing that stretches the boundaries may curb credit growth and reduce increase household resilience. So what has been done in terms of addressing these vulnerabilities in adding resilience in Norway? Capital requirements have increased in recent years. On the advice of Norges Bank, the counter-cyclical capital buffer has been set at 2%, effective from the end of the year. And citing from Norges Bank's letter to the Ministry of Finance giving this advice summarizes our view on this. So I'll read. Household debt accumulation is high, partly owing to the rapid rise in house prices. This increases the vulnerability of many households and heightens the rise of a sharp fall in demand and an increase in loan losses for banks further out. High house price inflation and a continued rise in household debt ratios are signs that financial imbalances are building up further. This suggests a higher counter-cyclical capital buffer rate, and the Ministry of Finance followed our advice. The Norwegian authorities also introduced credit standard requirements. The requirements were first introduced in 2010 as guidelines from the FSA. These requirements have been tightened and changed in the recent years. The first tightening was introduced in 2011, when the maximum LTV ratio was reduced to 85%. So, what kind of an effect do such measures have? I think this figure illustrates the effect of such measures and also the limitations of it. The blue curve shows the distribution of loan-to-value ratios for first-time home buyers in 2011, when the 2010 regulations were in place. We see that a number of, there was a spike at an LTV of 90, but also a high spike at 100%, where many home buyers had additional collateral. After the tightening, we see a considerable, but not a complete effect. Now there's a spike at 85%, but the spike at 100% is more or less unchanged. So we see there's a considerable, but not a complete effect of such measures on borrowing. And there was a change in regulation from June 2015, where the guidelines were formalized as a regulation with an LTV of 85%, a stress test that borrowers should pass a stress test of a 5% interest rate increase, and an amortization requirement, and then speed limit introduced of 10% introduced to maintain flexibility. That 10% of new loans are permitted to breach one or more of the requirements. And the FSA's lending survey shows that the restrictions had some effect, but not a huge effect. It has an effect of the LTV ratio, but still the liquidity shortfall, the number of households not passing a stress test did not reduce very much. And then there's a tighter regulation from January this year. Now it is introduced a debt to gross annual income ratio, sort of a debt to income ratio of 5. The amortization requirement was tightened to an LTV of 60%. And then there was a regional requirement of an LTV of 60% for secondary home buyers in Oslo. And there was also sort of a tighter speed limit in Oslo. The FSA's survey of loans for the fall of 2016 shows that the DTI measure probably will be will be binding, since a number of new loans exceeded 5 times exceeded the now implemented DTI measure of 5%. And anecdotal evidence now shows that banks have tightened their credit practice, in particular with respect to the DTI measure. House price inflation then, according, has slowed in recent months, in particular in areas that show the highest rate of house price inflation through 2016. 3-month moving average of house prices in Oslo has decreased from around 30% at the end of last year to under 10% now. And house prices are expected to rise at a slower rate ahead, partly reflecting high rate of residential construction in areas where the house price increases have been very fast. As you see here, the building permits in Oslo, that has increased quite a bit over the last 2 years. This is also expected to relieve the pressure on prices for existing houses. So, summing up, house price inflation is important for predicting debt growth and signals financial imbalances and possible financial crisis. Macroprudential measures are best suited to build resilience in banks and households. That's their main objective. A secondary objective is to limit credit growth, and which of course may have some effect on house prices, but this is not, in our view, their main target. But since house price, although when we look at sort of the possible effects of it, at least in the short term, of course we study house prices. Since house price inflation is a leading indicator of household credit growth, it is also sort of a signal in the short term of the effect of macroprudential measures. But there are a host of other factors affecting house prices. And another one has been mentioned here. So then, in our view, it's far from obvious that macroprudential measures should be used to target house prices, even from a second-best perspective. And it cannot be the only way of evaluating the effect of macroprudential policy, although it's certainly the most important short-term indicator, as sort of the effect of it shows up in house prices, and the lag in credit growth terms tend to come in much later.